Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Long-term debt to capital ratio compares long-term debt to total capital from the latest balance sheet. Total capital is long-term debt plus total equity plus minority interest. Lower is typically better since it implies that there is less of a debt burden on the company. For example, a company with $10 million in long-term debt and $50 million in total capital would have a long-term debt to capital ratio of 20%. A company with the same amount of long-term debt but only $25 million in total capital would have a higher ratio of 40%. The first company has less debt in their total capital structure and possibly less risk to equity investors. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the long-term debt to capital ratio is falling, is this because long-term debt is decreasing or is total capital increasing? Or could it be a combination of both? In this example, Medtronic's long-term debt-to-capital ratio has been very steady for the past 8 years and is currently near its 10-year median of 32%. A lower leverage ratio is preferred typically. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity, though some use of debt is also warranted.